Good morning and welcome. Thank you for joining us for today's special presentation, Creative Planning with Completed Gift, Self-Settled Dynasty Trusts. My name is Brandon Centula. I am the Chief Fiduciary Officer of Peak Trust Company with offices in Alaska and Nevada. As many of you know, Peak is a full-service trust company that provides reliable and accessible expertise to help you with your clients' complex trust plans. Before we get started, I would like to take care of a few housekeeping items. Today's presentation is being recorded, and we will provide both the recording and slides to all attendees. Please enter any questions you have into the Zoom panel. We will address as many as possible at the end of the presentation. Today, we are excited to be joined by Jonathan Gottman, who I've known and worked with for more than 20 years. Jonathan is a partner in Ackerman's Naples office. He also spends substantial time in their Fort Lauderdale office. His practice focuses on sophisticated wealth accumulation and preservation planning strategies. Jonathan is an adjunct professor in taxation at Ave Maria Law School and a frequent commentator on asset protection planning matters for Lineberg Information Services. Jonathan has authored, been interviewed for, and quoted in numerous articles in well-known publications. Jonathan has been and continues to be recognized as one of the top 100 estate planning attorneys in the country and is considered one of the leading experts in the world on asset protection planning. The truth is, I could probably spend the entire hour talking about his numerous accomplishments. We are very lucky to have him with us here today. With that, I'll turn it over to Jonathan.
Well, thank you for inviting me to do this. What I want to do in the short presentation that we have for you today is, one, address the gift tax issues, two, address the estate tax issues and generation skipping tax issues, and then talk to you a little bit about income tax issues as well. Then focus a tiny bit on compliance, and then perhaps a little bit of creative planning as well in this area. Get you to think about why you'd want to use these trusts, how you'd want to draft these trusts and design these trusts for your clients to accomplish your clients' tax objectives. Okay, so first off, let's talk about the estate and gift tax, which are really the most important issues and fundamental issues here in designing these types of trusts. So you have the gift tax, and as you know, that's a tax on the transfer of property during life, and the estate tax is a tax on the transfer of property at death. We call these excise taxes or transfer taxes. And the gift tax, you have some weapons that you can use to fight off the gift tax. Okay, the gift tax right now, the highest rate is 40%, but that's only incurred after you exhaust your exemption amount and for gifts in excess of the annual exclusion as well. So you can make a gift as a donor to any donee of up to $15,000 a year, and as long as that's a present interest gift, that will qualify for the annual exclusion. Many of you know that when you use a trust, and these trusts are no different, if you use what we call crummy powers and you give the beneficiaries limited withdrawal rights, unfettered withdrawal rights, or demand rights for a certain period immediately following a gift, you can qualify those gifts to the trust for the annual exclusion. Okay, now that's under present law, and there's been some talk and proposals to change that, but present law right now is you can include those withdrawal rights in a trust. Okay, and everyone designs them a little bit differently, but if you include those withdrawal rights in a trust, you can qualify for the annual exclusion. Second, okay, you have and by the way, if you're married, you can double that on a per donee basis, and you have $30,000 per donee. If you have 4 kids and you're married, or you have 2 kids or 3 kids, those numbers start to add up. So it's not an insignificant resource to use on an annual basis, and you either use it or lose it. Over and above that, you have your estate and gift, your combined estate and gift tax exemption, which right now is just a tiny bit because of indexing, just below $12 million per taxpayer. And again, you get to double that, so close to $24 million per taxpayer if you're married, and you use that gift tax exemption the right way. And then, and again, if you, to the extent you use it during lifetime, you've exhausted it at death, and it continues. This is an area, again, where there's a lot of changes on the horizon, whether we get further legislation or not. We started out before President Trump took office with a $5 million base that was indexed, and that was increasing significantly due to the cost of living increases that we got every year. Under the 2017 Tax Act, that increased or doubled that amount from $5 million base to a $10 million base, indexed again, with a sunset on that, so that by the time we reached 2025, that amount would revert back to the $5 million base, whatever it was indexed to at that time. Okay, and yeah, that's on a use it or lose it basis. So whether that happens or whether we get further changes either this year or next year, if we have the opportunity to use it and their changes aren't retroactive, again, it's on a use it or lose it basis. So if you use up your exemption this year, you have your clients have a technique to that or mechanism, you could use up almost your $12 million exemption per taxpayer. And even though that exemption reverts back, we know from regulations that were released by the IRS a couple of years ago that there's no way that can be used against you to create an adverse tax consequence, either a state or gift tax consequence, at a later time, assuming that exemption is lowered by legislation or we hit the time where it sunsets. So that's important to understand. After that, the concept here that's most important is your ability to make a completed gift, okay? And this is where it gets important to understand underlying state law. So in Alaska and in Nevada, and also, fairness, in several other states, not quite a majority yet, you have these extensive trust codes that have been passed. And the big difference between Alaska and most other states, okay, other than the group, and these states, the laws vary slightly, and you have to be aware of the different changes between these states when you're using them, because they cover different things, they provide different benefits. Alaska and Nevada happen to be two of the broadest states out there, but basically what they say is they change the general rule of the common law, okay? And so what they say is you can go into Alaska or Nevada, you can settle a trust, and as long as you comply with their trust laws, you have a sufficient nexus to their states, you can settle a trust, and your settlor either directly, okay, or in an indirect fashion can remain a discretionary beneficiary of that trust, and their creditors cannot reach those, or his or her creditors cannot reach the assets of that trust. So in theory, if I create a trust, put $1 million in it, I appoint Brandon either individually as an Alaska resident or the Peak Trust Company that qualifies under the Act. If I appoint Brandon, or the trust company as a trustee of the trust, and then I make that transfer in, technically under Alaska law, provided I haven't committed a fraudulent transfer, my creditors now can't reach those assets, even though I might remain a discretionary beneficiary of the trust. Well, if you look back, the concept of the gift tax and being able to make a completed gift, you have the concept of giving up dominion and control, okay? Now, I do a lot of work in the asset protection trust area, and oftentimes we have very large transfers that are made into these self-settled trusts for asset protection purposes. Many of my clients don't want to pay any gift tax, or most of them don't want to pay any gift tax, all of them don't want to pay any gift tax on those transfers when we're transferring in $100 million plus of assets into the trust. So what we do is we include provisions, and again, Alaska law and Nevada law provide what you can include in there and what you can't. And we include provisions, typically a veto power, for instance, in the settlor, the donor settlor. So if the trustee or protector wants to direct a distribution out of a trust, or an investment committee, or a distribution committee wants to do that, you have to get the settlor's consent to do that. That's one way to create to cause a gift to be incomplete. But also, that's not the only mechanism you have to include, because you can't give up full dominion and control. You also have to include a testamentary special power of appointment in that trust that's retained by the grantor as well. And it's very important you include both those mechanisms in there. And that's extremely important in those situations. But if I don't include those mechanisms and I just leave the grantor with a mere right to potentially receive distributions in the trustee's discretion, and again, my grantor's creditors can't reach those assets, well then under the gift tax laws, and this is very clear, those the assets that I've transferred to that trust will be treated as as a completed gift. Okay. It sounds, if you haven't practiced in this area, you'd say to yourself, well, I'm a little bit edgy about that, with the grantor retaining a right. But what I can tell you is in the outline that I provided to you, there's literally over 30 cases that have covered this issue over the years for a variety of reasons. It goes back and predates the Alaska law in 1997 and also predates a lot of the trust codes here. But there's substantial case law on this issue that exists out there. There's also revenue rulings and plenty of private letter rulings as well on the issue. And the revenue rulings that are cited and discussed in the outline are most important to focus on as well, because those tell you what the law is in this area. And then if you look at the estate and gift tax, well, when you give an asset away and you've gotten it out of your gift tax base, the way you can include it in your estate is if you retained some type of taxable string. Well, we know it's not an asset that you own under 2031. Okay, not to get too technical with gift tax regulations, gift tax code sections and regulations, but we know it's not an asset that you own, but it could be an asset that you retained a taxable string, either under Section 2036, 2037, or 2038. Section 2036 and 2038 are really the ones, the code sections you have to be most wary of and cognizant of how they operate. And again, if you notice from the authority that's out there, a mere discretionary interest without your creditors being able to reach those assets is not going to be sufficient under either of those, under any of the string provisions to pull those assets back into the grantor's estate. Okay, now that's very important to understand. Now, what I can tell you is over the years, and I'm sure Brandon has experienced this as well, because I know that a number of people do these trusts with both their Nevada company, also their Alaska company, and I've done a number of them over the years. We've had clients that have died. We've filed gift tax returns. We've reported the trust. We've included the trust. We've actually filed gift tax returns and state tax returns that included the trust, specifically directed the service to the provisions in those trusts. And we've never had an audit or an issue raised on audit related to those trusts or an argument that the assets in those trusts should be includable in their estate. Now, you can say there's a number of different reasons why that might happen. We've had some pretty large estates of people that have died that have never taken any distributions from these trusts who needed it. We just included this sort of a safety mechanism. The other thing that I will tell you, I think it's important to focus on here, and one of the reasons why the service hasn't raised the issue is if you look at their internal revenue manual, their litigation manual, there's a specific provision in that litigation manual that that tells you that the service cannot take a position in an audit or in a case that is opposite to a stated position or published position of the service. So that's not something you find in the private letter ruling, but certainly in a revenue ruling. And of course, as I told you, there's revenue rulings out there. Service is free, by the way, to take a position that's opposite to a result that happened in a circuit court or in a district court. The Supreme Court decision would have a different bearing on that. But when you have that rule in the service's own litigation manual, and with those revenue rulings that are out there, unless you veer so far from those facts that are in those revenue rulings, I believe that's the main reason why the service does not raise that issue, because it would be contrary to their stated, their publicly stated positions. They would have to change that to take a different position. Now, it doesn't mean that you're free and clear of any issues that could come up. One of the most significant issues that you have to be aware of, and where the service has been successful, is arguing that after you make this transfer, you look beyond the terms of the trust, and if there's some type of implied agreement between a fiduciary, the protector, or the trustee, that if you have that implied agreement and the actions of the parties deem otherwise than what was written in the trust document, well, then maybe you can get a different result. We call that the implied agreement theory. And you set up a trust. The protector or the trustee, every year there's income that's earned by the trust and the assets put in. Even though it's a discretionary distribution, every year consistently the trustees distribute out all or almost all of the income back to the settlor. Well, that creates a pattern of distributions, and the service could actually use that pattern of distributions against you. Now, what I can tell you is, again, if you look to the case law, there's a case cited in your outline called Gisela Wells, the state of Gisela Wells, and you had what I would have deemed to be an extremely abusive situation. That was probably the best case the service is going to see in this area. You had a son and an accountant appointed as the co-trustees of a trust that Mrs. Wells set up. And every year, the trust would earn $30,000 of income. This is an old trust, many, many decades ago. And the trustees would distribute that income out to Gisela so she could go on a worldwide trip that year. And they did this for every year until she died. So you had a consistent pattern there. You had a son who was also a beneficiary and a remainder beneficiary of the trust, obviously. And then you had the accountant. Who else is going to follow their mother's wishes? And then a son and a Jewish accountant. So it's that's just what that's just what happens in the Jewish world that I've been a part of all my life. I think the service had the best possible facts there to win on, and the court still said, because the son testified appropriately, the accountant testified appropriately, said all the right things. They had a very good lawyer. They said that wasn't an abusive situation, and that's not going to pull those assets back into the estate under 2036. And the last thing I'll point out about that too is both Nevada and Alaska have specific, what I would call bootstrap statutes that say if you have a suggestion of this implied agreement, and this would happen anyway under common law of a state anyway, if you have this implied agreement beyond the four corners of the trust document, that agreement is void as against public policy. And it should be anyway, because it creates a potential liability in the beneficiaries of the trust. Because if you have an independent fiduciary, it's highly unlikely the service could ever raise this argument for a number of reasons. But they had their best case in Gisela Wells, and so I just wanted to point that out and mention it. Then we get to the GST tax here. Okay, so let me go back just real quick. So the creditor's rights doctrine is extremely important. Okay, we get that creditor's rights doctrine, going back several hundred years in the trust laws from the English common law. It related to a tax rule in the early years, and it morphed into a public policy rule. It was adopted by many states by statute. The trust code has that rule as its majority rule right now. It was adopted in each of the restatements, and it's very clear. If you set up a trust and you remain a discretionary beneficiary in the common law and the statutes of many states, if you remain a discretionary beneficiary, the settlor's creditors can reach those assets to the maximum extent that the trustee, regardless, it could be an independent trustee or not, can make those distributions back to the settlor of any amount. So that opens up, and it doesn't matter what the assets are that are retained. It could be Bill Gates. You could have billions of dollars of assets. If your creditors can reach those assets, okay, then under the creditor rights doctrine, that's a right. That's treated as a right to revoke under the estate and gift tax law, and the entire corpus of that trust will be pulled back into your estate when you die, and there's no completed gift, and that's very clear under the transfer tax laws. Fast forward now, and you have a number of these states like Alaska and Nevada who have passed legislation that specifically reverses that common law doctrine, self-settled trust doctrine, and says that if you comply with our trust laws, okay, your creditors can't reach those assets. Okay, very important to understand, because that's where you get a different result in the estate and gift tax area. Now, if you get a different result in the estate and gift tax area, the one thing we didn't talk about here was GST tax. Okay, now I'm not going to go into the details of the GST tax. That's beyond the scope of this discussion. But if you make a completed gift into these trusts, and you don't have a state tax inclusion, you can also allocate or have an automatic allocation of GST exemption to these trusts as well. So you can make the trust GST exempt too, okay? Talking about, and we all know that we have a GST exemption equal to the maximum amount of the estate and gift tax exemption. Now, they're not always congruent, okay? So you can use them in different ways, and that's important to understand as well. Let's talk a little bit about the income tax as well, because even though you create one of these self-settled trusts, even though it's a completed gift, there are ways to design these trusts so that you can shift the tax burden, the income tax burden, from the settlor. In most situations, it's a wholly owned grantor trust as the settlor, and that's the result we want because it's the perfect way of making a gift in today's world. You want your settlor, you want your wealthy client to retain that tax liability, report it on his or her tax return, and have a legal obligation to pay that income tax on the assets, the capital gain, the interest, the dividends, etc., that are earned or generated inside those trust assets. And the reason for that is, again, it's because of the Rev Proc that's discussed in your outline. There's certainly plenty of authority that predated that Rev Proc, but in that situation, your settlor is making an additional economic gift to the trust that's not treated as a taxable gift because the legal obligation to pay the tax is shifted by law, by the tax code, to the settlor of the trust or the grantor of the trust. And that's extremely important to understand. So we like to do that in most situations. There are limited situations, however, especially for clients that don't live in Florida or states that don't have an income tax, but they live in states that do have a high income tax. And there may be limited situations where you want to create one of these trusts and you want to make it a non-grantor trust, which again is possible. It's actually possible to do that with an incomplete gift trust as well. And I can tell you, Peak Trust Company is a number of times in Alaska, and it's done that a number of times in Nevada. It has a long history in this area as well, help people save on state income taxes. And usually it's a substantial amount of money or tax dollars that you save by avoiding or being hit by state income tax. You can't do that in New York, by the way, and that's a discussion that's beyond the scope of this discussion now because because of some changes that occurred recently under New York law. But going back to the non-grantor trust status and with the incomplete gifts, there are literally, and these are all cited in your outline, over 100 PLRs dealing with people making transfers into incomplete gift trusts that are designed as non-grantor trusts to avoid state income tax. Each of those PLRs has one thing in common that's very important to the planning we're talking about today for state and gift tax purposes, okay? You need to know that the service respects these types of trusts. So the vast majority, actually all of those private letter rulings involved people that lived in one state that did not have the self-settled trust, that did not legislatively reverse the self-settled trust doctrine like Alaska, okay? But what they all had was people going to states like Alaska and Nevada, and going to Nevada and Alaska for that matter, creating these trusts and funding them. And the only way those trusts would work and be respected, because if a New York resident or a New Jersey resident or a Connecticut resident or North Carolina resident went to Alaska and created one of these trusts, and someone said, well, you live in New York or you live in New Jersey and we're going to apply New York or New Jersey law, well, then New York and New Jersey have the self-settled trust doctrine. We know that. Okay, well, that's kind of that if the service could apply that, or under trust law in theory, you could apply that rule, well, these trusts just aren't going to work. But the service recognizes that if you have an Alaska trust, you're going to settle those types of issues, the creditor's rights issues, if everything is done the right way, in an Alaska court. And for that reason, okay, the service in each of those letter rulings respects the status of the trust. Okay, again, that is an unconditional approval of doing planning in this area and structuring these trusts. We also have a few private letter rulings that attorneys have gotten over the years for their clients where they've set these trusts up not for state income tax planning, but for estate planning purposes. And we've gotten favorable private letter rulings on some or all of the issues that are important. The gift tax issues and the estate and gift tax issues now as well in more recent rulings. So Now we've covered the gift tax, we covered the estate tax, we covered the GST tax, we've even addressed the income tax, okay? Think about this, okay? We have large exemptions now. We may not have a large exemption next year. We know we're not going to have too large, we'll have a large exemption, but not too large exemptions there. Not too large an exemption if everything is left alone. That's a figure of speech because it is a large exemption regardless. If there's a sunset that happens anyway under current law, I'm guessing that by the end of next year, we'll see some tax legislation that drastically reduces the estate and gift tax exemption down to somewhere around $3.5 million, if not at the $3.5 million mark. And many of our clients will have lost the opportunity to take full advantage of that $20 million. If you're worth $20 million, if you're worth $30 million, if you're worth $40 million, if you're worth $50 million, you may be worth a lot of money, but if we all do our planning the right way, and most of us do, and we do excellent planning, you can make your estate and gift tax exemptions worth a lot more to our clients in a number of different ways. And someone who's worth $30 million, asking them to give away $22 million of wealth combined, okay, may be a difficult thing to do when they're looking at their balance sheet. But if you can explain to them that they will remain discretionary beneficiaries of the trust, and they'll have a trap door, maybe it'll be easier for them to do that. Because they know they can eat away at their remaining wealth without giving up the security. We know we can be aggressive with discount planning and structuring all sorts of leverage transactions into that trust after the trust is set up, and we don't have to get our clients to think too much about it. If we overdo it, which I've done in a few cases, if there's just too much in these trusts years down the road, we have that trap door where you can make distributions back to both spouses, okay? So very important to understand that. Now, one thing I do want to say too, and careful in the way you design and structure these trusts, most of the time we're doing joint trusts when our clients are married, but we're very careful the way we transfer assets into these trusts. You can't, this goes back to the gift tax, we talked about the concept of gift splitting, okay? When a spouse is a discretionary beneficiary, or in this case, for the settlor and the settler's spouse are discretionary beneficiaries, you can't gift split transfers into this trust. The one exception is if there's crummy rights, crummy powers that we talked about at the beginning, where a third-party beneficiary, not the spouses, have withdrawal rights over those beneficiaries, then you can gift split as to the amount withdrawable by beneficiary. Everything above that, you can't gift split here. So we're very careful to make sure husband and wife, when we have two spouses, or wife and wife, or husband and husband, make the transfers into this trust directly themselves. And there's no gift splitting option here, okay? Very important to understand. Secondly, okay, designing the trust. Some of you, I understand, may be skittish. I'm not, okay? When it comes to these rules, for a variety of reasons, we are very careful when we counsel our clients. But when we create these trusts, some people, and I've done this before as well, because there's other advisors involved and you want to make sure you appease everyone. But to design these trusts, you can set them up where it's what we call a SLAT, spousal lifetime access trust. So you set it up for your spouse, you put the assets in, but if your spouse predeceases you, then you become a beneficiary, or your client, your settlor, becomes a beneficiary of that trust after the surviving spouse, after his or her spouse passes away. Okay, so again, important to understand, there are other ways of going about making the settlor a beneficiary. For instance, the settlor can be added at a later date as to some or all of the trust, and that's okay. I think that's here, neither here nor there. You got to be careful about the substance of what you're doing. But in today's world, with such a large exemption, even when we're seeing the ultra high net worth client, when you're asking them to make these transfers in, you're asking them to maximize the amount they can get into these trusts, you're asking them to retain the income tax liability for that matter, it can be rather daunting to our clients. So I'm just pointing out the flexibility, and this allows me to go to my clients and say, don't even think about this right now. We're going to lose those exemptions. We did a lot of this for the last 5 years. And I said, when they give us a large exemption, we just take advantage of it. We get our clients to continue to take advantage of it and set these trusts up, fund them, and then not forget about them, but realize they're an added resource. They can still manage the wealth, either directly or indirectly inside of these trusts. They can, and they have that trap door just in case they need it back. Again, this is a lot of understanding the uses of resources of wealth, and income. You either, you need your income to live off of and consume. We don't want to take that away from someone. You need your income for current investment, for having to live deals, real estate deals, to grow companies and things like that. And you need your income and your assets for a rainy day, and that's future growth and investment here. And we're still talking about rainy day with the ultra high net worth, or even not even the ultra high net worth in some situations, because ultra high net worth, I believe, starts at $30 million. So again, just getting your clients to focus on the enormity of the situation and the amount of tax that they're going to be saving their families when they pass away if they implement this planning now. I actually have a longtime client, one of my lower net worth clients coming in today, but worth $22 million, and we talked about setting up one of these trusts because of the issues that we're facing, and again, an interesting conversation. But he's finally decided to proceed with it. So we've gone through the estate and gift tax, we've gone through the GST tax, we've gone through the income tax issues, and now let's talk about a couple of more situations. We talked about how flexible these arrangements can be and why they're so creative to use right now with our clients. There are other things you can do with these structures that make them even a bit more creative. So, the first, and I do this a number of times with domestic trusts, just because you have an Alaska trust, just because you have a Nevada trust, or you name your favorite state, it could even be Florida for that matter, or wherever you're located today, and you're in a domestic state, the federal tax laws are different from your state tax laws. So you can have an Alaska trust, and Alaska is clearly part of the United States. Nevada is clearly part of the United States, but if you design the trust the right way, it's going to be a foreign trust for income tax purposes. And it's easy enough to do and fail that test. Okay, we call it the control test and the court test. And it's a conjunctive test. So you fail either side, and you snooze, you lose here in your foreign trust. Now, why is that important here to me? Well, we have this tax called the Section 684 tax, which is a tax on the value of the trust assets, okay, a mark-to-market tax, capital gains tax, where your settlor is treated as having sold the assets the moment before he or she dies to the trust at fair market value when it converts to a non-grantor trust at the grantor's death. Okay, so and these are regulations under 684 that tells you that sale is deemed to occur right before the person dies. Okay, so why is that important? Well, with traditional grantor trusts, you typically have highly appreciated assets you put in there. If you time it the right way, you sell the assets during the grantor's lifetime. Remember what I told you, the grantor picks up that income tax on his or her tax return, pays the capital gains tax, pays the interest and dividend taxes on the interest and dividends, and that value remains in the trust. Okay? Now, with a domestic trust, if the grantor, we know the grantor is dying or close to death, we typically want to take high basis assets or cash and replace those assets with the assets that are in the trust, taking the low basis assets, highly appreciated assets, and putting them back into the grantor's estate, so that when the grantor dies, you get what's called a stepped up basis, which happens under Section 1014E. Now that's important planning to understand and focus on, but most of the time in practice, whether we want to admit it or not, we don't get that timing right. You get a call when the client is not in the position to do that. Clients are wealthy, they're involved in all sorts of good business deals. So when they die, now the trust takes a carryover basis in most people's arguments. And when the trust goes to sell the assets, now the trust is going to recognize the capital gain because there's no estate tax inclusion. And that's not a great situation. But in my situation, if I didn't get the timing right and I had a domestic trust that I designed as a foreign trust, and again, easy to do, easy to fail the control test, a variety of ways that we can do it, okay, but if we guessed, and and my grantor dies, and I have that sale that's treated the moment before death, I'm assuming we have the same economic interest on both sides. The estate has the same beneficiaries as the trust, okay? Then you have that deemed sale. The estate picks up, the gain is picked up, or the sale of the assets is picked up on the grantor's final income tax return. So that's a deductible liability. It's deductible on the estate tax return. You end up with a mirror image result had those assets been sold during the grantor's lifetime or removed and brought to the estate. So it costs the estate a few shekels of income tax, but it's a good economic result. So I like planning in that area. And again, very easy to do. The outline talks about how we accomplish that. And again, I just want people to focus on that's a possibility here of implementing. The other thing we love to put into these trusts, again, income tax savings for high net worth families is all sorts of insurance arrangements, like private placement life insurance is a big planning strategy that we use inside of these trusts. And basically what that does is it allows families that have accumulated wealth, and it's a private placement life insurance policy is what I call a souped up variable contract. So on the lower end, say low, I use the lower end loosely, variable insurance contracts can mirror some of the benefits of a private placement life insurance policy. The private life insurance policy has a lot more flexibility in designing the investments inside of it, as long as you comply with all the rules, which are again beyond the scope of this discussion. But but you get tax-free buildup, which is incredibly important. And not only tax-free buildup, if you plan it the right way, you can withdraw the gain inside of the policy tax-free as well, and never pay tax on that. You withdraw it in a number of different ways, or a few different ways that would avoid the tax liability. And that's the strategy with it. We also use business insurance that can be owned inside the structure. I'm not talking about captive insurance, which I know a little bit has become out of favor, but there's some insurance strategies that produce far better results than captive insurance these days, where you can get a 162 ordinary necessary business expense deduction off of your cash flow. This works particularly well with pass-through entities like S corporations and partnerships. And you get the 162 ordinary necessary business expense deduction going in. The insurance this is usually issued through a traditional insurance company, but they give you what's called a SAC account, a segregated asset account. So 60% or so of your premium goes into your segregated asset account. After the premium is earned, if there's no claims on the policy or a few claims, the remaining 40% is released, which is good. You need that for shared risk in the pool, and that goes into your fund. You get actually what amounts to tax-free buildup in your SAC account, which you don't in the captive. And when you go to withdraw the SAC account years down the road, which you're not limited by time or anything like that, you can withdraw it at capital gains rates. You're also not limited, since the PATH Act, in the way that your SAC account can be owned. So it can be owned by a Dynasty trust. It can be owned by an asset protection trust. And you don't have the limitations that are set forth in the PATH Act. So I like, on all grounds, I like the SAC planning a lot more. But we've also designed SAC planning where you can use it for the ultra high net worth family with a private placement life insurance policy, which further enhances the income tax benefits here. I'm happy to talk about that as well. And it can all be owned through an Alaska or Nevada trust that you form with Peak. So again, happy to talk about that with people if you want to call. We're going to move over to questions and answers here right now, but I will point out, I know I've talked about a lot and fed you a lot of information. I apologize for feeding it to you as quickly as I have, and I know it might be a little bit difficult to digest. On my materials, and certainly you can write this down, you can reach me by email, and you can reach me by telephone. Please feel free to reach out to me if you have any questions. My email is Jonathan, Jonathan, Gottman, G-O-P, as in Grand Old Party, man, as in Superman, Batman, Robin, at Akerman, AKERMAN.com. And my cell phone is 561-306-4599. You can call me or text me. If I can't answer the phone, just leave a message and I will get back to you as soon as I can. Brandon, let me turn it back over to you to ask questions.
Thank you, Jonathan, for your presentation so far. We have a couple of fact patterns for you. The first fact pattern is this. Harry and Wendy are residents of Florida and have been married for 40 years. Harry is a neurosurgeon, still works, as does Wendy, who is a practicing transactional lawyer. They have a combined marital estate of approximately $30 million with no debt. They have 3 children, Juan, Dosie, and Trey. Juan is an ophthalmologist, Dosie is an ER nurse, and Trey is a social worker. What might you suggest for this family?
Oh, 1, 2, and 3. Okay. Yeah, this is the perfect example of a person that cries out for an Alaska or Nevada trust, where they're worth $30 million. They're still working. They're still high income. Mom may be making a few $100,000. Dad may be clearing in excess of $1 million a year as a neurosurgeon. Their kids are off and well and doing well in one form or another. They've raised 3 good kids. They're independent. Here, with the potential of losing the exemption, particularly if they're liquid, it would be an excellent opportunity to shift some of that wealth, a large portion of it, into their trust where they can secure the full use of their current exemptions, remain discretionary beneficiaries. We always advise our clients in this situation to make sure that when they leave their wealth to their children, it stays in trust, not only for the tax issues, because you have generations getting exempt trusts, but also for the asset protection that your kids get out of that when they pass that wealth. They can virtually be given control of the investment of that wealth. They can be given the authority to direct how it's distributed when they die if they want to change the ultimate disposition, and yet it would be there for them during their lifetime for their use and living off of. But if they ever get divorced, which we all know happens at a significant rate in this world today, if they have tort creditors, if they claim bankruptcy, anything they do, the assets in those trusts should be beyond the reach of a creditor in that situation. And what I point out is even in that situation, Alaska and Nevada law go a step further than most states. Almost every state provides protection for third-party trusts that are created by a settlor for the benefit of someone else other than the settlor. However, not all states are created equal, and you have case law in many states and statutes that allow creditors certain inroads that might surprise you. Florida is one of those states that might surprise you. We have some adverse case law. So I rarely do a trust in Florida anymore because of that case law, which I know is going to sneak up and shock a number of people. I know has already snuck up and shocked a number of people. So Alaska and Nevada have various statutes that they've passed over the years that provide an additional layer of support that typically deal with every issue you could think of that could come up, that has come up in other states, including Florida, over the last several years, where they say, with those issues aside that happen in Florida, we can tell you by statute it can't happen here and it never will. So we advise clients that way. But this is a perfect situation where Harry and Wendy should be creating an Alaska trust, funding it.
Perfect. So we'll move on to fact pattern number 2. In this case, we have Mark and Rebecca, who are non-resident aliens who are citizens and reside in Monaco. Since 2 of their 3 children now live permanently in the United States and have a few children of their own, Mark and Rebecca are considering moving to the United States permanently. They're worth several $billions. What might you plan for these non-resident aliens?
This is a perfect opportunity before they arrive here. What we advise our clients to do is engage in what we refer to as pre-immigration planning. Okay, one of the great contradictions here in the United States is that if you're extremely wealthy and you want to move here, if you do your planning in advance, you can virtually ensure that your family will never pay any estate tax or gift taxes ever. Certain trusts can last forever if you go to the right jurisdiction, or can last for many, many generations, depending upon the jurisdictions that you choose. And so that's the first concept that's very important. But if you do pre-immigration planning properly, you may be able to get some tremendous income tax results for your clients too by doing basis boosts in assets before they arrive, selling assets, particularly if they live in a place like Monaco that's very friendly to the wealthy as far as income taxes go and things like that. So just recognizing income before arrival, things like that. But we would set up trusts in Alaska and Nevada and potentially other places when the dollars are large, what we call shelter trusts. And they may be self-settled trusts, they may be trusts, with a number of different beneficiaries. It just depends on the number that we're doing. And we'll shelter that wealth from the U.S. estate and gift tax system before they arrive. Now, it's going to be subject to the income tax system once they're here and become permanent residents, but it's sheltered from the estate and gift tax virtually forever, or what seems like forever in most situations, particularly with wealth at that large an extent. And we can make these trusts, again, very flexible, where distributions can be made to charities directly and things like that. So that's important to understand in this situation. So that's what we're going to advise in this situation, particularly if there's a lot of liquidity. We're probably going to advise this family to use replacement life insurance as well. We'll also ask the question, when you say you're coming here permanently, do you mean permanently or do you mean for 4 or 5 years? The planning might differ drastically depending upon the answer to that question, but if they're coming here permanently, we're definitely going with the shelter trusts. And as long as there's no U.S. situs assets going in, and that's a very limited term, and most people in this situation are not going to have U.S. situs, they've done the right planning over the years, are not going to have any U.S. situs assets, so we're going to be able to transfer in most of that wealth and save an enormous amount of estate and gift tax for many generations to come.
Thanks, Jonathan. Sounds very powerful. Next, we have Brian and Andrea, who are tech entrepreneurs who met at their latest startup company, Yell It Loud. They have already made several $1 million hopping around a few successful startups in Silicon Valley. They are in love, and they plan to marry shortly. They each have founder stock in Yell It Loud, and they just found out a major private equity firm is considering a sizable investment in their company because the technology is cutting edge and far ahead of any competitor. Again, what might you do with this couple?
This is screaming for a younger couple to set up a trust in Alaska. Each of them on their own. Obviously, there may be some premarital planning benefits out of doing that before they get married, so they can protect their wealth from each other if they ever get divorced. We can put the concept of a qualified spouse into the trust, so if they ever get divorced and they get remarried, that next spouse could be a beneficiary, but just a discretionary beneficiary. And you get it in while it has a very low value, and even though the private equity firm is looking at it, if they haven't made the investment yet and haven't signed on to make that investment, that stock may still be valued quite low, and be high, and a number of contingencies affect that value. So now's the time to set up that trust and fund it. And again, on the theory that their stock could go from being worth virtually nothing to being worth hundreds of millions of dollars in the tech world by doing this, because they're young, they're not giving up access to that wealth because they'll remain discretionary beneficiaries.
Fantastic. Our last fact pattern for today is as follows. Bob settled a trust in Florida for the benefit of his spouse, Jane, and their descendants. He gifted his full exemption amount at the end of 2020, concerned the tax laws could change in 2021 or later, reducing the amount of estate and gift tax exemption. At the time of the gift, Bob and Jane believed Jane would survive Harry by a number of years, and thus neither would give up complete access to the funds gifted to the trust. Unfortunately, Jane was recently diagnosed with a debilitating disease that is likely to reduce her life expectancy by many years. Bob and Jane are now searching for a solution to the potential loss of access to the assets in this trust should Bob survive Jane. How can you help this couple?
In this situation, though, what it screams to do, and it's a very easy fix. I think Jane has a testamentary power of appointment in that trust instrument. What we're going to do is we're going to move the trust, the situs of the trust, if it was drafted the right way, to Alaska. We're going to change. We're going to appoint Peak Trust Company as our trustee. We're going to change the situs and the governing law of the trust and the administration of the trust to Alaska. So now it's a fully Alaska-based trust, and Jane's going to exercise that testamentary power of appointment in her will to leave the balance of the trust assets in a wholly discretionary trust for Bob. And that's, again, we're not going to give Bob a mandatory income interest. You would have to worry about Section 2038 under the string provisions in this situation, so be careful. But with the restructuring, and as long as it's an Alaska trust, we should be fine. So that's what we're doing there. There are also other opportunities that I'll point out, particularly because the decanting statute in Alaska is very progressive. It's way ahead of its time. It's one of the most progressive statutes out there, that you can move trusts that exist in other places and accomplish revisions to those trusts in one form or another using that decanting statute that you might not have been able to accomplish 10, 15, 20 years ago. And, as you'll know through previous planning that we've done together, Brandon, that we've used that statute a few times in the past to bring back flexibility that the clients thought were lost with trust structures that they've had in place for a number of years.
Absolutely, Jonathan. Decanting is as I found, one of the most powerful tools that we have. I want to remind the audience that Peak will be sending the slide deck and the recording to all of those in attendance. And please remember, if you have any questions, to enter those into the Zoom box below. Jonathan, we have time for a few questions. In your slide deck, I don't think you mentioned it so much today, but in the slide deck you talked about a committee structure. And the question is do you need a committee structure as you shared in the slides, or can you use an independent trustee with broad discretion, or an independent distribution advisor with broad discretion to distribute to the grantor or any of the grantor's descendants? Setting up a committee may be more burdensome.
You
Any thoughts on that?
Can. And as you know, in our trusts, we give both the trustee discretion and we give a protector the power to direct the trustee, as to distributions, and that's usually one person. We like that person to be independent, but you can't have a distribution advisor under the Nevada statute, under the Alaska statute. You can have one person. It doesn't matter what you call it. We call that person the protector or the distribution protector in our trusts. It could be a distribution advisor. You can give the trustee broad discretion. The only thing I'll point out, when you give the trustee broad discretion, the reason why Peak is so successful in both Alaska and Nevada is because it's what we call an administrative trustee, and you have these directed trust statutes that when you have another party vested with that traditional trustee function to direct the trustee in exercising that authority, whether it's investments or whether it's distribution authority, that absolves the trustee of certain liability, which is important to the trustee. And when you want to vest the trustee with that authority, that changes the fiduciary relationship again. Thereby, I would imagine that the fee that Peak would want in that situation will go up quite a bit because it's taking on additional liability.
Thank you, Jonathan. If the grantor needs cash to pay income taxes as a result of a trust having grantor trust status, should the trust make a distribution to the grantor if permissible, or should the trustee consider making a loan to the grantor?
In that situation, I'd rather do it as a loan, because you can always pay a loan back. Once the distribution is made, distribution is out, and if you have creditor issues or other issues, now you're going to have to document that loan. You should charge interest, and it should be paid on an annual basis, in my opinion. And eventually consider paying it back unless there's an asset or a liquidity issue. And if there is, then you can always distribute out the note either to the grantor or to the beneficiary that took the loan.
Well, Jonathan, thank you very much. We've consumed more time than we had set aside today, so I think this concludes our presentation today. On behalf of Peak Trust Company and the over 800 registered attendees, I want to personally thank you for your insight and strategic comments, along with your practical case studies. Again, I remind the audience that on the very last page of the slide deck, you'll find Jonathan's contact information as well as my contact information. If you have any questions or comments, please reach out to either one of us. Other than that, we thank you again for your participation, and we wish you a great day. Thanks so much.